break our contracts down into as many specific performance obligations as possible. So we're trying to determine how many performance obligations are distinct within that contract. And the accounting rules say a performance obligation is distinct if two things hold. The customer can use the good or service on its own or together with other goods or services that can be obtained elsewhere. Sometimes you might hear the term for being able to obtain goods or services elsewhere. We might see the term readily available. Goods or services that are readily available. Okay, so what are we talking about here? Picture a company that's selling razor blades, razors on the stick, together with these cartridges. Okay, so a company has a contract to sell both the razor without the cartridge and separately also selling the cartridges. If the company ships just the handle on the razor and the cartridges are going to be shipped later, should that company recognize revenue when it's only delivered this portion of the contract? Well, it depends. Depends on whether these cartridges can be found by the customer elsewhere. The customer can just go to any store, pick up these cartridges by another manufacturer, then the company can record the revenue on simply delivering the razor. If this razor can only be used with these specific cartridges and the cartridges have not been shipped yet, in that case, the seller cannot record the revenue until it's fulfilled the entire contract, which is a usable razor. So it has to hold off on recording the revenue until the entire component has been shipped. So this first item, think about the example of the razor and cartridges. The second item has to hold as well. The good or service is separately identifiable from, not interrelated with, other goods and services in the contract. Separately identifiable from or not interrelated with. And the example I like to think about here is soup. So if the contract is to sell soup and the seller delivers some pasta and a can of tomato sauce, it has not delivered the soup because it has to be one integrated item. That's what the contract is for, is one integrated item, not the specific components that are going to later become the final good. Okay, if the performance obligations are not distinct, then they are combined and treated as one contract. And that's important because if components are delivered, but it's a combined single contract, revenue cannot be recorded by the seller until the entire item the entire performance obligation has been satisfied, or the entire contract has been fulfilled. Now let's look at a couple examples. Example 3, TrueTech manufactures the TriBox system. This is a gaming system allowing players to play with each other over the internet. The TriBox system includes the game console, as well as a 1-year subscription to a bunch of games that can be played over the internet. The internet games can be played using the console, but importantly, we see here the subscription. Customers can access the TriNet subscription using the game console or with other game consoles. Okay, so the question we're going to see here is when the company is selling the subscription for 60 together with the actual games console for 240, when they sell them together as a package deal for 250 and they deliver the game console, can it recognize the revenue on the console right away? Is that console usable by the customer? If not, then we have to wait until the internet subscription has been provided to the customer in order to recognize any revenue. So our question here is, are the subscription and the console distinct? In other words, are there two separate performance obligations? Yes, there are. Because the game console can be used without the subscription, and the subscription can be used without that specific game console. Okay, allocate the transaction price to each performance obligation. So we have two performance obligations. One is the console itself, delivery of that game console, and the other is the 12-month subscription. And we see on a standalone, if we just sell the console, it is sold for 240. If the company just sells the subscription, it sells for 60. So if we sold each item together, it would sell for 300. But when we bundle, when the company bundles and sells them together, it sells for 250. So when we deliver just the game console, as we'll see here on January 1st, the company delivers 1,000 game consoles. How much revenue do we recognize? On a standalone, it sells for 240. What we do is we allocate the transaction price between the console and the 12-month subscription based on their relative standalone values. Or in other words, their relative standalone selling prices. We say the game console is 240 out of the total 300. The game console represents 80% of the contract, and the 12-month subscription represents 20% of that contract. So when we deliver the game console, we can recognize revenue of 80% of the full contract amount. 1,000 TriBox systems at a price of $250 system plus 12-month subscription. So on January 1st, 2027, we're delivering the console. We're not getting any cash. The cash is going to be received from the customer on January 25th. On January 1st, we have an increase in accounts receivable. $1,000 units times $250 per unit. This is the game console plus the 12-month subscription. So of course our assets are going to increase by $250,000, and we're going to record sales revenue because we've just delivered 1,000 TriBox game consoles. And we're going to recognize revenue not for the entire 1,250. We're going to take the full 250,000 and record revenue on 80% of that, because the game consoles represent 80% of the entire contract amount. And that is going to be for a total of 200,000 even. Okay, so our entry is off by 50,000. Where are we going to record that 50,000? That is the remaining 20% of my contract that will be fulfilled over time as that internet subscription is provided to our customers. So we now owe it to our customers. We're going to increase the liability account deferred revenue. Okay, deferred revenue again causes our liabilities to increase, and the credit to sales revenue, of course, increases the revenues that would be reported on the income statement. On January 25th, the company receives cash from the customer. So we're going to debit cash for the full contract amount, $250,000. And we're going to decrease accounts receivable. So now our balance in accounts receivable is 0. The debit to cash causes assets to increase, and the credit to accounts receivable causes assets to decrease. Part C says record the entry on January 31st. So we don't see any transaction taking place on January 31st, but we need to remember that over time, this deferred revenue of 50,000 is going to be recorded as revenue evenly over the 12-month subscription period. So at the end of each month, we're going to record 1/12 of 50,000. So at the end of January, we're going to debit to decrease the liability account deferred revenue. And 50,000 divided by allocated across 12 months works out to be 4,167. And the other side of this journal entry is to recognize the service revenue on the internet service that we're providing, or the games for 1 month over the internet. This entry here is going to be recorded at the end of January 31st, the end of February, the end of March, all the way through December 31st, so for the full 12 months. And of course, what this entry does, a debit to deferred revenue, is a decrease to the company's liabilities, and a credit to revenue is an increase to revenues on the income statement. The end of the period after 12 months go by, deferred revenue will then have a balance of 0. Service revenue for the 1 year would be 50,000, and the sales revenue that we recorded on January 1st would be on that annual income statement as well for the 200,000. Let's take a look at one more example. Macrovision sells a variety of satellite TV packages. The popular $600 basic package includes a hardware component, and that consists of a satellite dish and a receiver, along with, just like last example, a 12-month subscription to 130 TV channels. Okay, so we have the hardware. The company sells the hardware component without a subscription. So on a standalone basis, the hardware sells for $180. And so the company sells a 12-month subscription on a standalone basis for $540 per year. Okay, so what is the total amount of the two items if they were sold on a standalone basis? $720. They're selling it together for $600. So we need to know when just the hardware is delivered, what percentage of the total standalone is that going to be? We have 180 divided by 720. That is going to be 25% of the total contract amount. and 540 out of 720. The subscription is 75% of that contract amount. Identify the performance obligations. That's pretty straightforward. It's going to be the hardware and the subscription. And determine when revenue should be recognized. Revenue on the hardware should be when we deliver the satellite dish and the receiver, and recognize on the subscription should be recorded evenly over the 1 year period. And for most companies, the entries would be recorded monthly. Item 2 says for the single basic package that was sold on January 1st, allocate the $600 transaction price to the performance obligations in the contract and prepare the journal entry to record the sale. Okay, so we have, let's do our journal entry on January 1st. On January 1st, the company receives the cash. $600. We don't know how many units are being sold, so we'll just say the entire 600. And we're going to deliver on January 1st. We're delivering the hardware. So we're going to record sales revenue. Let's say it's just 1 unit. That would be 25% of the 600. 150. And then the remainder we're going to put into deferred revenue or liability account. This relates to the 1 year subscription. Okay, then prepare any necessary journal entry to record revenue on January 31st. So just like in our last example on January 31st, we need to record the fact that we've recognized 1/12, 1 month of the deferred revenue. So I'm going to debit to decrease deferred revenue, reducing my liabilities. That's going to be $37.50 or $38. And then I'm going to increase service revenue by that same amount.